Hey, good evening, everyone. My name is Dimitri with Sense Financial Services. I will be your host today, and our presenter will be Tony Watson. Welcome to this webinar, Use It or Lose It. The countdown for year-end tax planning begins. I'm just going to take a couple of minutes. We still have a number of people. We had a pretty overwhelming response to this. We had almost 200 registered for this, and still have people popping in.
Once again, apologies, folks, for not being able to share the screen earlier. It's funny because I do 140 webinars on average per year, and it never ceases to amaze me when I run into a new glitch. And I know that this program is just very, very stellar compared to other programs that we use, and I need to figure out what went on. But tonight we're here to learn about proper year-end planning. We're counting down the minutes, it seems like, till the end of 2022. We're going to say goodbye to a very interesting and intriguing year coming out of that 2020, 2021 very interesting 2-year period of the pandemic years. And we're still dealing with it for the most part. And the economy is ebbing and flowing as it normally does coming out of some period like we've just been through. But I think that what stays consistent year over year is the importance of setting aside some time prior to the end of the calendar year to sit down with your tax advisors and figure out creative ways to retain the wealth that you've built for yourself, and hopefully not overspend with Uncle Sam and the wonderful state of California or whatever state you are currently filing in. So, Dimitri, if you can go to the next slide. The first couple slides are just, kind of to get you familiar with me, here at Robert Hall & Associates, a little bit about my firm, what we do at Robert Hall. I think I'm going on my 19th tax season coming up here pretty shortly in 2023. I not only am a practicing tax preparer and tax professional, my license is an EA license that I hold. I am licensed by the federal government to prepare taxes, not only at the federal level, but also at all state levels across the U.S. My individual clientele roster, I think total managed real estate and other business dealings, I think I'm well into the $500+ million range at the moment. And as the keynote speaker, like I mentioned earlier, we do about 140 plus events on a year-to-year basis. Go ahead and hit next slide, Dimitri. And I am by no means a one-man operation. We've got a wonderful senior accounting staff here at Robert Hall & Associates. We're about 54 employees strong, and we need to be that deep with employment to make it through roughly about 10,000 plus tax filings per year. We can go to the next one. And our business has been around since the early 70s. So like I mentioned, we do roughly over 10,000 tax filings per year. We've won a couple awards in the Southern California. And overall, I think just as a firm in total, we're well into the $1 billion in real estate operations management and wholesaling. We can go to the next. We're a one-stop shop for all of your financial needs, anything from tax preparation, our main service, all the way down to payroll, referral services, bookkeeping services. We also incorporate clients. So if you are looking to seek advice on setting up an LLC or an S corporation or a C corporation, we can also incorporate your business and help you structure your investments in specific ways to help create greater liability protection for yourself, possibly even to set up structures in a way that could help reduce, at the end of the day, some self-employment tax that some of you self-employed real estate professionals might be having to pay towards the end of each year. One thing that I always ask my clients is, why do they think year-end is important to them? And I think the number one answer is to avoid unnecessary penalties and interest, which I think is a no-brainer, right? We all want to figure out what our projected liabilities are by December 31st and what we do need to cover to be in compliance with the IRS and the state agencies. So normally this is the number one answer as to why people think year-end planning is important. Go to the next slide. And this next slide I really want to focus on, because I think that positioning power, really kind of ties in what Sense Financial and Dimitri, what he and his company help our clients do prior to the end of the year. Positioning power is incredibly important when we figure out those year-to-date income figures, year-to-date expense figures, and we come up with that bottom line net revenue scenario. We need to figure out, that's where kind of the fun starts. That's where the real planning begins, because you've done your job. You've gone out there throughout the year, you've generated the income, you've spent what you can as far as reinvesting back into your business. And then that bottom line net profit is what we really need to dial in, figure out what we can dump into a self-directed, a solo 401k, both on the company side and the employee side, so that you can start diversifying your retirement portfolio and investing in real estate within that retirement plan, helping you defer the tax on all of this money that you're maximizing in these deferred accounts. So positioning power really kind of entails more than just your tax advisor and the plan that we put in place. Over the past, almost 2 decades that I've been working for Robert Hall, Dimitri has been a key player in that year-end planning positioning game that we play and the planning that we strategize for, as well as cost segregation specialists, 1031 exchange specialists. These are all incredibly beneficial positions to put yourself in prior to the end of the year, so that whatever you end up paying in this coming tax season or whatever you end up getting back, you know that it is the max money coming back or the bare minimum liability that you'll have to owe with your filing for that calendar year. And then number 3, if we can go to the next slide, number 3 is probably the most common answer. It's peace of mind. I want to know what the heck happened this year. I was so busy managing my properties, acquiring assets, dealing with new business ventures, figuring out checks and balances, debits, credits in my own account. Now I need to figure how much I owe in overall federal and state income tax. And I want to make sure that I know that without surprises come tax season, so that I can set aside that money and be readily available to make those payments. So peace of mind is probably the most common answer amongst all 3 of these. And whether you are answering number 1, 2, or 3, I think that we can all agree that, through proper planning, we are planning to succeed. We're planning to hit a result that we are all happy with, right? When you leave your tax preparer's office, you're okay with whatever that bottom line was, because you know that you've been able to retain that wealth for as long of a period as possible. And remember the famous saying, the one that I really like to mention in every single webinar: failing to plan is ultimately planning to fail. You will not like the results. There will be surprises if you do not set aside some time towards the end of the year to sit down with your tax advisors, your 401k specialists, your cost seg specialists, your exchange specialists. You will not like the results come tax time because you failed to plan. So peace of mind is really important, especially in our industry, the wonderful world of taxation. So let's go to the next slide.
And Tony, before we go to the next slide, I just posted a poll there, folks. If you can submit your answer, just yes or no, that will be awesome.
Perfect. And during these year-end planning, I call them interviews. I like to interview my clients because I need to figure out what the heck happened over the past 300 plus days, right? How did the year start off? How was the second quarter? How was the third quarter? And then obviously, if you have been prepaying your taxes throughout the year, what are we on track to either overpaying, underpaying, or are we right in line with what the projected liability will be? And a lot of clients say, well, I have these estimated tax payments and I know that I owe certain amounts, but how were these calculated? And so I always like to explain to clients that the federal government has 2 pretty darn easy calculations to go off of as far as estimated tax payments are concerned. And the government wants you to cover either 90% of the current year liability or 110% of the previous year's liability, just to make sure that you are either covering a liability in a higher gross revenue year. For instance, if in 2021, let's say that you had overall net income that you were paying tax on at 100 grand, and 2020 was absolutely a killer year, you were crushing it, and your income jumped from 100 grand in net profit up to 250,000. Well, obviously covering 110% of the previous year's liability would not come close to covering the liability on that significant jump in revenue. So we need to talk with our clients throughout the year to dial in this 90-110 calculation to make sure that we are on track to not overpaying and not underpaying the federal government, but paying just enough to ensure that the client is not going to be assessed underpayment penalties, estimate penalties, and most importantly, interest. And coming out of the past 3 years, I really want to let clients know that there were some significant changes in clients' spending during the pandemic, specifically my real estate investor clients. So I'm going to talk really quickly about some of the top tax deductions for clients coming out of the pandemic. And one that I didn't include on this list that probably is really important and pertinent to tonight's webinar is deferred compensation plans. I had more people deferring taxable revenue into their solo 401ks and self-directed IRAs over the past 2.5 years than ever before in my 19-year career. I think that people, because of the pandemic, they really started to look at their personal finances under a thicker microscope. seeing what kind of wealth they've been able to retain for themselves. How many years do they have to plan ahead before retirement, or even clients that are entering into retirement already, do they have enough to actually live a quality life in retirement, accessing money from their 401ks, maybe through government, having money from government pensions or cash flow from real estate investments. So, the deferred retirement, that was really, really one of the things that I find to be a kind of an inspiring note coming out of the pandemic, that this really dark kind of 2.5, 3 year period of all of our lives, that people really started focusing on personal wealth management. They started really focusing on building a thorough and vast team of professionals and surrounding themselves with like-minded professionals. So we saw some significant changes in the deferral of money into retirement plans. But as far as general deductions are concerned, probably the number one expense, if we can go to the next slide, the number one expense that changed the most during the pandemic was people's marketing and advertising costs. I saw a direct correlation between income revenue streams increasing and also the increased expense of marketing and advertising costs. Some of my clients who 4x'd, 5x'd their costs on the marketing and advertising side saw 2, 3, 4x in revenue during the pandemic. And they're still seeing that growth in revenue in 2022 and moving forward. They're closing out the 2022 calendar year pretty darn strong. And so we saw a significant uptick in marketing and advertising expenses. I love this write-off because, number one, it's exercising rule number 2 in business. Reinvest your profit back into infrastructure. Number 1 rule in business is pay your employees, right? Pay your employees and they'll do great things for you. Many hands make for light work. Number 2 rule in business, reinvest profit back into infrastructure, which in this case would be marketing, advertising, infrastructure as far as office expenses, new computer equipment, faster servers, whatever whatever you can invest your profit into to make your business more efficient and allow you to do what you do in a more efficient way is obviously a great overall deduction. And number 3 rule in business is pay as little tax as possible by exercising rule number 2. And rule number 2 was just spending money on reinvesting back into infrastructure. So if you follow these rules of business, for you, it's just a matter of not where is the ceiling. It's, I see the ceiling, I'm going to break through it. Now, how do I restructure and figure out other creative ways to retain wealth? So this was a very, very interesting and unique pivot entering into 2020 and 2021 as we started to see marketing and advertising costs really start to skyrocket. Number 2, if we can go to the next slide, number 2 is probably some of the more common deductions for business owners and real estate investors: professional supplies and equipment. I always ask my clients, do you know anyone in your circle of professionals that you work alongside who can do what they do day in and day out without a computer, without a cell phone, without a desk, without a chair, without a filing cabinet? These expenses, professional supplies and equipment, have one of the lowest risks for audit amongst all deductions across all platforms: Schedule E's, Schedule C's, LLC's, S Corp, C Corps, because the government knows that professional supplies and equipment are some of the most consistent write-offs for self-employed individuals as well as real estate investors. I like this for a number of reasons. One, it has a very low risk for audit. And number 2, you have options of how to write these expenses off. If you've already invested all of your profit back into infrastructure and you're already at kind of a zero balance due scenario with the IRS in the state of California, why accelerate a computer deduction if you don't need it this year? So you have the option of either taking it all in one year or spreading that computer or a desk or chair or other equipment purchases. You have the option of spreading it out over the depreciation lifespan of the asset. A computer and a cell phone, for instance, have 7-year lifespans. So you can either take it all in one year by accelerating it, that's called Section 179ing the deduction, or you can spread it out over the following 7 years. And let's say 2 or 3 years down the line, the cash flow really starts to kick up again. You can take the remaining 3 or 4 years of depreciation and accelerate it in the year when you actually need it. So number 1, it has a really low risk for audit. Number 2, you have options of how to write this off. Professional supplies and equipment, great overall deduction and tax shelter for business owners. Number 3, if we can go to the next slide. Car and truck expenses. I'm sure that you've all heard about the feeding frenzy around vehicle purchases during the pandemic years. In fact, I was joking with a client earlier. You look out the window and see this car parked in your driveway that you've owned for a while or that you're currently leasing, and you're thinking, man, I could trade that vehicle in on the lease and actually get a credit against my new car. Like, I'd literally trade it in for a higher value than what I actually still owed on the car, what I originally leased it for. And we're seeing this more so with cars that are owned outright, where the car that's sitting in your driveway that you own actually appreciated in value over the past 2 years. I mean, who would have thought, right? But we saw a lot of people taking advantage of this kind of appreciated automotive industry, these appreciated values, trading them in for new vehicles and re-kicking or restarting that massive depreciation deduction to offset income. I had a lot of real estate investors, portfolio managers exercise the bonus depreciation rules on heavyweight vehicles, the Tesla Model X's, the Range Rovers, the GMC Sierras, these large 6,000 pound or heavier vehicles up through the end of this calendar year, December 31st of 2022, they qualify for something called 100% bonus depreciation. Sorry, I have a little bit of a hiccup. And that allows us to take 100% of the value of this vehicle if it is titled, insured, and paid for in the correct ways. It allows us to take 100% of the value of that vehicle as a dollar for dollar write-off all in 1 year. Now, I say that takes us out through the end of this year, December 31st of 2022, because as of January 1st of 2023, that 100% bonus depreciation number drops to 80%. So we lose 20% steam on that. We don't lose it as a write-off. It's just we're allowed 80% as of next year, beginning of next year. And we have to take that excess 20% and now depreciate it over the lifespan of the asset, which a vehicle has a 5-year lifespan. If you're not looking to buy a new vehicle or pay off a leased vehicle and convert it to a depreciating asset, you're probably taking either the mileage write-off at roughly 60 plus cents on the business mile, or actual auto costs, an engine repair or rebuild, tire replacements, oil replacements, or oil changes. So have this conversation with your tax advisor about how to operate this expense from a deduction standpoint on your returns. If you're a rental property owner, sometimes I'll see clients with 5 or 6 Schedule E's. And because it's not active business income, it's rental income, which rental income is not ordinary income. It's not taxed at the self-employed tax rates, at least. We will set up a 6th Schedule E to report all of their operation costs, which for those of you who are investors, you know that on the individual return, when all the Schedule E's consolidate, those deductions will offset the cash flow amongst your other Schedule E's. So there's some really creative opportunities for real estate investors here as far as auto and truck and other operational costs are concerned. Let's head to slide number 4. Number 4 would be something that's kind of unique to my industry as well as Dimitri's industry, legal and professional fees. Back in 2018, the federal government removed a form called a 2106 form from the individual return. And that meant that they got rid of legal and professional fees as deductions. And the general public, the United States taxpayer, feared that they weren't going to be able to deduct their tax preparation fees or their attorney fees or contract, if an attorney's reviewing a lease contract or a lease agreement of some sort, that those fees would no longer be a tax write-off. Well, what they failed to understand about the 2018 tax reform bill is that the 2106 form only applied to W-2 employees, not to real estate investors and not to self-employed individuals. So we as real estate investors and as self-employed business owners, we are still allowed the dollar for dollar deduction of legal and professional fees on Form Schedule E, Schedule C, or an entity filing like an S Corp or an LLC, multi-member LLC, or even a C corporation. So legal and professional fees, great overall write-offs. We saw significant changes around this deduction during the pandemic years. Obviously, like I mentioned earlier, a lot more people are setting up their living trusts, taking more of a personal approach to their wealth management and wealth planning, and really looking and focusing more to help retain this wealth that they built for themselves and protect their legacy assets for their beneficiaries. So let's go on to number 5. Last but not least, bonus depreciation on real estate investments. Dimitri probably can talk a little bit about this as well. We've seen a lot of people really get really involved in the syndication type investments. They've been 1031 exchanging into syndications. They've been starting their own syndications, little small syndication investments. And then you've got the real estate investors who own individual rental properties on Form Schedule E that they actively manage. But whether you are investing in a syndication or just a multi-unit building that you own personally, cost segregation over the past 2.5 to 3 years has become more popular than any other election on an individual tax return, in my opinion. In fact, over the past 2.5 years, I filed more cost segregation election tax returns than collectively accumulated or cumulative over the past 19 years that I've worked in the industry. I don't know if that's the right word, but overall, I filed more in the past 2.5 years than I ever thought I would. Now, for those of you who don't know or understand what cost segregation is, cost seg is an election to accelerate and take future year depreciation deductions in this calendar year. So for those of you who are veteran real estate investors, a residential property has a 27.5-year lifespan. So you buy a property, it's building and land, and the building itself has a certain value and the land has a certain value. The building itself can be deducted as a rental property investment. The residential building portion itself can be deducted over a 27.5-year period. So let's call the building a $500,000 value. Land is going to be, let's say, $400,000. You take $500,000 divided by 27.5 years, you get a depreciation write-off of about 18 grand per year for the next 27.5 years. Great overall write-off. I also refer to depreciation as a phantom expense. But imagine being able to tap into the future year depreciation write-offs to free up those deductions for this calendar year, especially if you have other kind of passive and non-passive income in investments that are cash flowing like crazy. And you're thinking, well, I've kind of tapped out on all of my operational costs. I don't really want to pay or force myself to pay any additional legal and professional fees just for, additional tax sheltering benefits. But if you could tap into those future bonus depreciation write-offs, accelerate them and take them all in this year, wipe out your taxable income, pay no liability this year, and with this tax savings now reinvest that into other real estate investments, now you're talking about a very powerful wealth building position and tool that you can use to retain wealth. And possibly, even if you don't use all of the deductions this year, guess what? They become part of an unallowed passive loss carry forward, and you can spread these deductions out over multiple years. So not only are you not paying tax in this year, but if you have excess losses because of this accelerated bonus depreciation that you can carry forward into 2023 and then into 2024. And I have one client who right now is projecting with his cost seg election to carry it forward at least minimum 4 to 5 years. For the next 4 to 5 years, unless anything drastic changes with this financial situation, he'll be paying zero tax for the next 4 or 5 years on all of his cash flowing investments. So cost segregation has been just an incredible election to make on the 2022 returns, 2021, 2020. And it's not too late, by the way. So we are at December 6th right now. This cost segregation election does not need to happen prior to the end of this year. It can actually be made as an election next year to carry back to 2022. It is one of the holy grails of tax shelters under the current Internal Revenue Code. And through December 31st of this year, it is still at 100%. As of January 1st of 2023, if you do this cost segregation election, you don't get the full 100%. That drops to an 80% benefit. Once again, I'm not complaining about an 80% accelerated deduction, but we have to make sure that we understand that 80% next year means 60% in 2024, then 40% in 2025, 20% in 2026, and it fully sunsets in 2027. So make sure that you are connecting with your tax advisors about this special election and connecting with the right individuals to exercise this election and figure out if it's right for you. It's not going to be right for everybody, but pretty much 95% of the people I connect with on cost segregation elections and doing the analysis, 95% of them say this is a no-brainer. This allows me to offset all of my cash flow, retain all of that unpaid tax, and now I can reinvest or cycle that money back into my current investments, or even buy or use that tax savings as a future down payment on a new real estate investment property. So bonus depreciation is just like I said, the holy grail of tax shelters, and you can always reach out to Robert Hull and Associates to dive further into detail about that particular election. Now, understanding the Inflation Reduction Act, this is something that I have gotten a ton of questions on, and I know that it was a very interesting kind of, let's see, it's December now, so almost a year and 2 months ago, the current administration had opened up what's called, or written or introduced something called a Green Book initiative, where it was basically a wish list of the Biden administration's hopeful changes to the Internal Revenue Code for 2022 and 2023. At the 23rd hour, they changed a lot of things in the Inflation Reduction Act. One in particular that I'm very happy about is that they did not change Section 1031 of the Internal Revenue Code. The 1031 exchange still has a no limit cap, meaning that instead of dropping it to a $500,000 cap on deferred gain per taxpayer, the federal government at the 23rd hour said, we're not going to change a part of the Internal Revenue Code that's over 100 years old. We're going to keep everything set and in place. And so that is a no limit amount for a 1031 exchange. Thank goodness. Bonus depreciation rules. We talked about how the 100% bonus depreciation is good through the end of this year. It will drop to 80% as of January 1st of next year. Some changes to the energy efficiency credits. Obviously, we have the 24% solar credit, solar system credit still in place. 26% solar energy credit in 2022. That will bump up to 30% as of January 1st of next year. There will be reinstated credits for energy efficient appliances, hot water boilers. I mean, there's a number of things, there's a whole list on the IRS website that will now qualify for these energy efficiency related credits. Same with building energy efficiency credits. If you want to learn more about the developer side of these energy efficient credits, that's a whole other webinar in itself. But it's very interesting to see how much of a green initiative is behind the Inflation Reduction Act. I'm not going to say all of the Inflation Reduction Act is good, and that the tax goods have been the tax gods have been good in this case. But I do like the green initiative. I do think that we do need to increase the credits to make the builders of the U.S. here, the developers, focus more on the green initiative, building more energy efficient properties. But that solar system credit does jump from 26 to 30% as of January 1st of 2023. Just to help everybody sleep a little bit better at night, obviously everybody has heard that there are some updates to the new IRS employment figures where we've heard that 87,000 new agents are coming on board with the IRS. I do have to let you know that in the first quarter of 2021, the IRS numbers, as far as employment is concerned, the amount of employees working for the Internal Revenue Service dropped to an all-time low. On average, prior to the pandemic, each year, the IRS held about 80 to 90,000 employees on staff year over year. And sure, they go through a hiring, firing, kind of like a seasonal layoff period because obviously tax season is busy. Then they don't need a lot of people employed up until the extension filing season. And then they rehire for tax season. But on average, about 80 to 90,000 employees year over year. And in first quarter of 2021, the IRS employment figures dropped to 35,000 employees here in the U.S. The IRS dropped into a lull where they were backlogged up to 3+ million documents, kind of like backed up in the pipeline at the IRS. Refunds were being delayed. Processing of returns were being delayed. Mail was getting lost with the U.S. Postal Service. It was an absolute nightmare. And so the IRS was already planning on hiring new employees simply to fill seats with butts, right? But also what's very intriguing about these new figures, as I kind of dove further into a more analytical position of these figures and why this was happening, I found an article, actually several articles prior to the pandemic that had talked about the IRS estimating that 65% of their workforce was going to head into full-blown retirement by the year 2026. So the IRS had already budgeted for hiring about 40,000 new employees by the year of 2026 to make up for people being pushed into retirement. So this 87,000 new employment figure, I'm not afraid of it. I don't think that it's going to trigger an increased risk for audit. Obviously we'll build case study about this over the next 2 to 3 years because that's usually how long it takes for any acts like the Inflation Reduction Act really to trickle down to us, the U.S. taxpayer. But we will be building case study on what the IRS is now focusing on, what they are trying to make an example of, or who they are trying to make an example of. And to be real honest with you, I think that it's going to be kind of cut and copy from past years. They're after the C corporations of the world. They're after the billionaires of the world. And we've heard this $400,000 income threshold that they're going to be focusing on. Yes, that is true. But at the end of the day, $400,000 or above, if you've got W-2s, if you've got entity structure set up the correct way, and if you are in compliance with everything that you're supposed to be compliant with, reasonable salary payouts, tax return filings for corporate and individual, as well as 5,500 reporting requirements for retirement plans. If you are in compliance, you should not have any higher risk of audit than any year before prior to the pandemic. So make sure that you understand that this is a lot of fear-based media that's just being pumped down our throats right now. Listen to your tax advisors and listen to what their case studies are over the next 2 to 3 years. And obviously make some assumptions on your own after talking with these licensed advisors. As we approach the end of the year, on top of all of the Inflation Reduction Act adjustments, we are understanding that with inflation and deflation, that the brackets will change, standard deductions will change, but the focal point is still around how do we shelter as much of our earned income as possible. So right now, as we approach the end of this calendar year, many of my clients are getting in touch with their financial brokers, especially Dimitri at Sense Financial, which is such a unique product that he offers to our clients, where these 401ks, when we max them out at their max deferred amounts, these 401ks have the ability to invest in more than just the common investment under an IRA or 401k, like the stock market investments. I have many clients who have made significant wealth within their deferred retirement accounts, actually not even their deferred retirement accounts, but also their solo Roth 401ks, where it grows tax-free. So this is something that you want to separate some time towards the end of the year to sit down with your tax advisors, map out those figures, and if you can, at every corner, max out all of those deferred contributions or Roth contributions. Right now is just a fantastic time to really hone in on your own wealth building platform and talk with, once again, all of the licensed advisors that surround you. And I just want to openly thank Dimitri and Sense Financial for helping so many of our clients with these solo 401k investments. I don't think in my 19-year career, I've known Dimitri probably over a decade and a half now, I have not seen one client come back to me and say a solo 401k was the bad choice for me, or a self-directed IRA was a bad choice for me. Not one. And no joke, out of my 1,200 tax returns I prepare on a year-to-year basis, I'd say, just a rough estimate, I'd say that I probably have north of 500 clients who have solo 401ks and self-directed IRAs. They are a consistent wealth building tool amongst my 1% clients, the individuals who have significant wealth and cash flow through unique investments and portfolio investments. So we can go to the next slide. This is just a slide that shows you kind of how to connect with our office at Robert Hall & Associates. We do offer free consultations. We are open for in-person meetings now. Thank goodness. I am back sitting at my desk in the Robert Hall & Associates building in sunny Glendale, California, after working from home for almost 2 years. I know that the pandemic is still alive and doing very well, but I don't ever plan on shutting down again. I am very much here for in-person appointments. So if you want to text Robert Hall to the number 72,000, that'll prompt you to sign up for a free consultation. We suggest sending over 2 years of tax returns to us to familiarize ourselves with your scenario. And that way, when we hop on the phone or meet in person, we already have the pieces of the puzzle laying in front of us. And we've already started to put that puzzle together. And then we can lead you kind of into the promised land, so to speak, of 2023. But most importantly, if you are not looking for a new tax advisor, at least submit this information to be part of our free webinar division. We'll let you know about our free educational seminars and our webinars. Like I said, we do about 140 events every year. This week alone, I'm on track to do 7 just this week alone. So all of our education is free, and education is a powerful tool for you as a real estate investor, especially when you talk about deferred comp plans and the ability to shelter money outside of the stock market in real estate investments, syndicating investments, so on and so forth. So, Dimitri, I'm sure that we have questions that the attendees have. I mean, we can open it up for questions, but I also want you to kind of give a personal example of what you've seen in your profession, some success stories possibly on your end.
Sure, Tony. We do have several questions, and folks, if you do have a question for Tony, now is the time to type it in the Q&A section of the webinar so that I can read it and everybody can benefit from that. Sure. But first question, when does it make sense to incorporate for a self-employed individual?
That is a great question, and I get this question a lot, and that's why one of the webinars that I do, which can be anywhere from an hour long to 4 hours long, is the power of Inc. And that is really diving further into detail about when the right and the wrong times are to incorporate. And after doing corporate tax filings or preparing corporate tax filings and advising clients on corporate structuring for many years, I've dialed in my calculation to kind of I don't know what the term for it is, but a sum number of $45,000 of net revenue, not gross revenue. I don't like to go off the gross revenue figure because that's not what you pay tax on, right? It's your gross income minus your deductions, minus all of the games that we put in play and the strategies that we come up with. Whatever that net income number is, that's what you end up paying your obligation and tax on. So after, almost 2 decades of doing taxes, $45,000 in net profit, self-employed net profit, that is the threshold to where you start losing money if you are not incorporated, meaning you're flushing money down the Social Security and Medicare drain, so to speak, and you're never going to see that again. At $45,000 of net profit, if you are self-employed as an individual and you start to make more than $45,000 in net profit, it costs you more to be self-employed than it does to be incorporated. Now, how the heck does that work, right? Well, at $45,000, you have the opportunity to take that 45 grand net profit as a corporation, S corporation specifically, and split that 45 grand into 2 figures. One number is your reasonable salary W-2 payout. And then whatever is left over in your business is something called a K1 flow through profit. And what you're doing is you're taking your self-employed revenue and splitting it into these 2 buckets, where now your W-2 at 35% reasonable comp payout is subject to federal, state, Social Security, and Medicare tax, and state disability insurance, unemployment insurance. All in payroll tax is about 16 to 17%. And on the K1 flow through profit, you are only paying federal and state income tax, meaning that on 65% of your $45,000 profit, you are avoiding, not evading. Remember, tax evasion is illegal. Tax avoidance is not. You are avoiding 15 to 16+% tax on 65% of your company's profit. So to answer your question, the right time to incorporate is when you hit that threshold. But once again, I don't want you to just hit that number and then go out and start a corporation. Once you consistently hit 45 grand in net profit, you need to pick up the phone and call your tax advisor and talk it through with your licensed preparer. And your CPA, your enrolled agent, whoever you trust. Shoot, it could be your priest or your rabbi if you trust them with your finances. But you got to talk with somebody and make sure that it makes sense for you to take that next step to incorporation, because we want to make sure that financially speaking, it saves you more than it's going to cost you to file as a corporation. So to answer your question about $45,000 in net profit, that's when you should open up the conversation about incorporating.
And then a similar question, kind of along this line, what are the advantages of the S corporation versus LLC?
Sure. The LLC actually saves you nothing in income tax. So that's the craziest thing about an LLC, and a lot of misinformation about that. LLCs are specifically for limiting liability. They are not tax saving structures. The S corporation is the only entity that can play the reasonable salary requirement game, which I just explained briefly about the 35% W-2, 65% K1 profit. The S corporation is the only entity that can actually follow those rules. Now, if you started an LLC and you are a self-employed individual, do not worry. It's not that you set up the wrong type of entity. You just need to make a special election for your LLC to be taxed as an S corporation. If you've started a C corporation and now you're realizing, oh my gosh, I should have set up as an S corporation, we can convert your C corporation to an S corporation simply by filing a subchapter S election form. So just because you set up a different type of entity doesn't mean that you're stuck in the mud, right? We can always convert your entity into the right type of entity to help you further reduce overall tax liability. But an LLC saves you nothing in tax. The S corporation is the only notable entity structure that has actually proven time and time again that it can actually help you retain wealth and reduce tax.
All right. Next question from Vicky. What are the changes to capital gains?
Yeah, so capital gains, I put that in that slide because at one point the federal government was talking about making capital gains above $1 million if you're married filing joint, whether it be long-term or short-term, making that capital gain tax 39.6%. If you were a single filing individual, at one point they were talking about making that, or implementing that at a threshold of $500,000 of income. So as you can imagine, if they got rid of the full-blown unlimited 1031 exchange and dropped it to $500,000, and somebody sells their home for $1 million gain and they're single, they get a $500,000 exclusion, or they exchange $1 million sale, $1 million gain. They're only allowed the deferral on 500,000, so they've got to include the other half as capital gain. And let's say they're adding that on top of a $250,000 W-2 income per year. Well, now that puts them at $750,000, right above the single individual's threshold of 500 grand. So in this scenario, $250,000 was the excess above 500 grand. Under the proposed code under the IRA, which didn't pass, that 250 grand of capital gain above and beyond $500,000 in overall income would have been subject to 39.6% federal long-term capital gain tax. And that doesn't even include recaptured depreciation. At the 23rd hour, the federal government decided not to implement that. So the rules still stand and are in place for 15% long-term capital gain. Higher income earners will be subject to 20% long-term capital gain. State of California is still at 9.3%. Sometimes it could be a little bit higher depending on your income threshold. And then you've got this wonderful 3.8% net investment tax. So overall, if your capital gain bumps you into a higher enough income bracket, your long-term capital gain tax could be somewhere around 33.1% roughly. But under the proposed code that didn't pass, I mean, shoot, you could have been seeing a 50+% long-term capital gain rate if that capital gain had bumped you above 500 grand as a single individual or $1 million married filing joint. Thank goodness that did not change. So everything is status quo with long-term capital gain.
Thank you, Tony. A question from David. How often can I replace the vehicle in my business?
Well, one thing that you don't want to do is become a car flipper. I get this question a lot as well, where, hey, listen, if I go out and buy this Chevy Tahoe for 60 grand, it's over 6,000 pounds. I get the 60 grand write-off now. Can I flip it and sell it and dispose of it next year and buy a new vehicle? Well, one, that's a silly idea because it's a depreciating asset. I'd much rather you go out and buy real estate, number one. Number two, you're still paying sales tax on the new acquisition. And sure, it's saving you tax on the back end, but the federal government, if you buy a vehicle this year and you dispose of it next year, they will expect you to recapture depreciation on the sale of that vehicle. So if you buy a vehicle for 60 grand, depreciate the full thing this year, get a 60 grand write-off, dispose of it next year and buy another $60,000 vehicle, let's say in 2023, remember, the bonus depreciation next year drops to 80%. So you're not replenishing the $60,000 write-off, or at least replenishing enough to cover a $60,000 depreciation recapture event in 2023. So I would suggest if you are going to buy new vehicles, you do not buy them within a 2 to 3 year period, because you would have enough depreciation recapture in that next year. And let's face it, you buy a 60 grand vehicle this year, it's not going to be worth nothing next year, right? Sure, depreciation wise, you took the full write-off, but that 60 grand vehicle, you could probably still sell for 50 grand next year. So you're not taking enough of a loss on that overall asset. 60 grand for 50 grand, that $10,000 loss is not going to fully offset the recaptured depreciation on the disposition of that asset. And when you replace it with a new asset, sure, that's a great write-off, but it's not like capturing an additional 50 to 60 grand write-off in that case. It's just replenishing or offsetting whatever depreciation recapture you'd have to pay tax on when you dispose of the 2022 vehicle purchase. That probably was super confusing. I know, because I'm mapping it through my head. I see the picture visually in my head, but you don't want to get into that business. You don't want to try to flip cars for the depreciation benefit, especially because the bonus depreciation is starting to phase out through to 2027.
All right, let's see if we can get maybe one or two more before the end of the hour and before we have to wrap this up. Question from Sam. Can I cancel my salary from my business and put the funds in a deferred compensation plan? I'm not sure if the question was structured correctly, but can you give it a shot?
Well, so as far as canceling your salary, remember that you have to at least hit, if you're under an S corporation reasonable salary payout, just to be in compliance, you have to hit at least 35% reasonable comp, right? So if you're at 25%, not quite at that 35% calculation, you have to at least bonus yourself out to bring you up to a minimum reasonable salary of 35%. And to be real, I'm being very vague with this because it depends on what industry you're in, right? Like if you're a contract physician, reasonable salary as a medical professional, self-employed medical professional, can be upwards of 55 to 60% reasonable comp. For reasonable salaries for real estate professionals, it can be as low as 35 to 40%. So it really all depends on what industry you're self-employed in. But if you've already hit that 35% reasonable salary, minimum reasonable salary cap, or limitation, then yes, you don't have to pay yourself anymore. And if you do pay yourself out a bonus check, you can defer all of that into a 401k if you are meeting that threshold, or if you're not exceeding the threshold of allowable contribution. That is more of a personal calculation question, I believe. If I'm reading it correctly, can I cancel my salary from my business and put the funds into a deferred compensation plan? You absolutely can, but remember, you have to meet those certain qualifications first, and you also have to pay yourself enough to allow yourself to put money into the deferred compensation plan. Dimitri, I don't know if you can chime in on that and maybe talk some specifics on that end.
Yeah, well, that's good enough, Tony. Let's do the last question.
Gotcha.
Does it make sense to use leverage in my self-directed IRA because of the UBIT tax?
Well, I know that some of my clients do use leverage within their self-directed retirement accounts, and there are specific lenders that work with lending against assets within retirement accounts. The UBIT filing requirement really isn't a scenario killer for me. Yes, I mean, technically the percent of property that's financed, that portion of the property should be paying unrelated business income tax. However, the majority of a cash flowing investment is enjoying the tax deferred benefit within the retirement account. So let me just circle down to the question. I can't see the question on my slide. Can you scroll down? I can't scroll down on my end, Dimitri, to see that question. I don't know if I answered it or not, but I think that the deferral on any portion of your cash flow or gain within a self-directed IRA account, whether there's UBIT filing or not, is still warranted, enough as a benefit to have self-directed IRAs and solo 401k investments.
Well, let me just add just one comment on this. If you're using leverage, you're using somebody else's money. So just to give you an example, you buy into $100,000 property, you put $100,000 down, and you get a loan for $100,000. Well, you acquire $200,000 worth of real estate using only 50% of funds, and you receive an income on the entire real estate purchase. So you actually, yes, it's going to cost you a little bit in taxes, typically not significant, but your use of leverage will definitely set you ahead in the game. But I think it's also, you have to look individual at each situation. But in my experience, usually it does make sense, even there is a little bit of a cost of UBIT.
I agree, 100%.
All right. Well, folks, it's 7 o'clock and it's 10 o'clock on the East Coast. Thank you for joining us. Great presentation, Tony. Great points and great questions. Wow, really great questions there. Thank you so much for joining us. We will we are recording this, so we will make the recording available if you want to rewatch that, and if you missed anything. Thank you for joining, and we will be doing some more webinars to help you guys on your path to growing your wealth and securing your retirement. Thank you again.
Thanks, everyone.